J'avais l'intention à donner mon discours entièrement en français. Mais ensuite, je me suis rendu compte que je n'ai pas vraiment parlé la langue il y a près de 40 ans. Et depuis que je l'étudiais au lycée et à l'université. En effet, mon vocabulaire, et peut-être plus important encore, mon accent, sont absolument terribles. Alors, je crois que ce serait mieux pour vos oreilles si je parle en anglais et laisse le traducteur faire son travail avec son accent parfait. Donc, s'il vous plaît, excusez-moi si je parle en anglais maintenant pour le reste de mon discours. Merci beaucoup. Thank you, Pierre, for the kind introduction. Ah, merci beaucoup. But Pierre, I wonder if they're applauding because I tried to speak in French, or whether because I stopped speaking in French. Bashir, thank you so much for your invitation and the selection of Prudential. I appreciate it very much to speak here today. I am honored to be here today in front of such a distinguished audience and to represent Prudential Financial of the United States at this very important conference. In terms of my speech, I will first provide some introductory remarks that speak to major shifts in consumer behavior, in distribution, and in terms of innovation. I'll then briefly describe both the US and the Japanese insurance markets, as well as touch upon Prudential Financial's entry strategy into Africa. Then I'll turn to some thoughts on regulation, and lastly, I'll share some summary remarks about our thoughts about the insurance industry in general. So let me start by describing major shifts in the insurance markets around the world. This past decade has witnessed major shifts in distribution in the global insurance industry, from the traditional tied agency system to new third-party channels and direct-to-consumer methods of distribution. The long-established model of agency and brokerage distribution, both by company employees and by independent agents, is being progressively disrupted by these new alternative channels. Technologies such as the internet, mobile, social media, and interactive voice response are accelerating the movement beyond traditional distribution channels. We have seen this trend first in the P&C industry, as we heard yesterday in some of the panels, which offers simpler products than life insurance. Direct writers now dominate both automobile and homeowner insurance sales in the US and are offering customized solutions to clients. There are more profound changes to the P&C business model because of new technologies such as telematics. Insurers now offer pay-as-you-go insurance. Customers pay premiums based on the miles they've driven or even by their driving habits in terms of how fast they accelerate or how hard they brake. And what's interesting is that by doing this, insurers are actually changing the way consumers drive. They're changing consumer behaviors. There are even more fundamental changes to the insurance business model on the horizon for self-driving cars. In this case, underwriting risk may shift from the driver of the car to the manufacturer of the car. Or take, for instance, home insurance. Insurance companies are now using drones to fly over people's houses to spot potential sources of damage and then offer to fix those problems before they become incidents that cost even more. So, for example, if a tree is leaning towards a house, the insurance company will come and offer to cut the tree down and not wait for the tree to fall on the house and crash through the roof. While we still have not seen these kind of disruptions in the life insurance industry the potential, or rather the threat, of transformative disruption to our traditional value chain and business models is very real. The two largest life insurance markets in the world, the US and Japan, together account for nearly a third of the global revenues. The US has more than $550 million, or billion dollars, excuse me, in annual life insurance premiums, and Japan has about $340 billion. These markets will likely profoundly change due to technology. There's also very interesting change taking place in emerging markets, such as Africa, India, and China, where direct-to-consumer models using mobile technology are emerging extremely quickly. As you may know, Kenya leads the world in mobile money, and the company M-Pesa has fundamentally transformed traditional retail banking. I was in Kenya recently with some of my colleagues and taking some other people out for dinner. And at the end, I pulled out a credit card. And the people we were taking out to dinner, the Kenyans, started laughing and saying, "You still use a credit card? We don't use credit cards anymore. You should, change." So mobile payment systems are also becoming a critical tool in a new generation of micro-insurance programs across Africa and many of the emerging markets. Insurers in emerging markets are not encumbered by the legacy infrastructure as insurers in the US and other developed markets like Japan are. As a result, the pace of innovation in these markets is something traditional insurers in mature markets are watching very closely. The second major shift is that digital technologies are changing consumer behavior and expectations. Technology is driving consumer demand for greater simplicity, fuller transparency, and instant fulfillment. Consumers today are embracing online and mobile channels for products, information, like never before. The ability to recognize these trends, modify strategies, and to seize opportunities is vital to the growth and success across all industries, including insurance. The third major shift is innovation, which is rapidly accelerating the insurance sector, and it must keep pace in order to succeed. Insurance firms across the globe are now embracing digital technologies and data analytics to engage consumers more directly, streamline their business processes, and reduce expenses. They are therefore spending more on research and development and investing heavily in innovation and technology, knowing full well that the pace of transformation will only increase over time. Digital technology and data analysis enable these insurers to provide customers with faster, more personalized interactions across the channel of their choice. Predictive modeling is just but one example. Based on data analytics, we can now determine when a customer may lapse a product and approach that customer with a new offer prior to the point of their lapsation. And it enables insurers to scale up their business models to improve efficiency and profitability while delivering enhanced customer service. So with that as background, let me talk for a moment about the disruption that is taking place with traditional distribution models. While conventional distribution channels, such as tied agency and third party, are still effective and widely used and will be used in the future, insurance agents and brokers across the globe are, in fact, experiencing changes in customer expectations. As mobile and social networks grow in popularity, consumers expect to use their smartphones and tablets to do research, price compare, and perhaps even buy online at a time and at a pace and place of their choosing. What's more, especially in developed economies, millennials are entering into their peak buying power years, meaning digital technology and automation must become an essential way of doing business in the future. Agents and brokers must be more agile, available, and resourceful to serve the key demographic segment in new ways. They must be able to connect to their customers and their prospects at any time and in any format of their customers' choosing, face-to-face, mobile, or online. There has to be flexibility. So the customers want a personalized experience, again, online or face-to-face, but also demand immediate fulfillment. The second requirement means that the companies need to digitize the workflow and business process, meaning the back office, to be more effective, timely, and cost efficient. And it's incumbent upon insurers to provide dynamic transactional capabilities that are uniform across all channels. Consistency of experience is important, no matter what medium the customer chooses. The uniformity requires digitization of the transactional activity, supported by advanced metrics and data. Robo-advisors, or online platforms that provide automated, algorithmic-based advice without the use of human financial planners, are also proving popular with digital consumers who prefer quick online purchases. In short, many consumers now expect insurance agents and brokers to provide a digital customer experience. Yesterday's insurance experience is inefficient and insufficient for today's demands and expectations. So now let me talk about some key trends in the US, and then I'll move on to key trends in Japan. Digital technology is now becoming fundamental to the US insurance industry. US insurers are implementing digital technology across the entire customer experience. When the customer researches what he or she wants to buy, when the customer buys, as well as servicing and claims. Many insurers today are focused on improving their digital capabilities, particularly with their internet portals and mobile applications, as well as the level of service they provide. For traditional distribution, digital is empowering tied agents and third-party advisors to deliver better and faster service. In other words, to be more productive. Digital technology is also providing ready access to client information through data analysis and a better understanding of consumers' behaviors